Hello and welcome everyone. I'm Susan Saravo and I'm joined by Bob Buchanan today. And Bob heads up our business transition planning. Bob, welcome.
Thanks, Susan. Great to be here.
Great to have you here. And all week long, we've been doing LinkedIn Lives for National Small Business Week. So this is exciting. And today we're going to be talking about transition considerations for small business owners. And if you have any questions for Bob, go ahead and put them in the chat and we'll get to those a little bit later. So before we start your presentation, Bob, I'm just going to ask you this quick question. We know a lot of business owners are going to be transitioning over the next decade or so. Give us some context to that.
Yeah, Susan, the numbers stay pretty consistent over a rolling 10-year period. And they've gone up over the last 20 years as the population has aged. And so a lot of baby boomers are retiring, they're selling their businesses. I think the numbers right now are something like 74% of all business owners will transition in the next 10 years. And that is a huge number of people and a huge amount of value that is going to change hands. Now, transition doesn't necessarily mean they're selling their businesses, but it means they're changing the position they have in their business. So they may be exiting day-to-day operations, or they may be actually exiting the company completely.
Well, we know there is a lot to consider for business owners, and you're going to focus on four main areas today. Tell us what those areas are.
So we're going to talk about change in portfolio risk, and that's very specific to business owners because people don't tend to realize what their actual portfolio looks like when they own a business and the risk that they carry in that portfolio. Along with portfolio risk comes change in income expectations. So oftentimes business owners have been dependent on the income from their businesses to meet their financial needs, which leads into financial needs. It's really important for business owners prior to exiting their business to understand what their needs will be going forward. And that leads straight into planning. So how do you plan for the financial needs that you'll have and the change in income expectations given the change in portfolio risk, right? So they all kind of stack together.
All right, that makes sense. So let's just go ahead and get started with the first one, portfolio risk. What do business owners need to know about that?
So business owners often or almost always carry a higher portfolio risk than non-business owners. And that's because a huge portion of their portfolio is tied up in this single asset, which is their business. And that business tends to be riskier than the other types of assets they hold. In addition, that large asset, often their largest asset, is completely illiquid. They can't just call their financial advisor and say, sell this tomorrow. It takes a lot of time and a lot of effort, and sometimes it's not even possible. And so planning ahead for that change is really important. And if you switch to the next slide, I think I'll show this in a more graphic way. That portfolio that's light blue is sort of a typical investor's portfolio. I'm not saying it's exactly an investor's portfolio, but generally you have a lot of stocks and bonds. There's some cash. There might be alternative investments in real estate. And that makes up what people consider to be their investment portfolio. But if you look at the dark blue one, that's more typical of a business owner. And so that entire light blue portfolio is squeezed into about 20% of the whole portfolio because 80% or more of their net worth is tied up in that business. And so that dark portion is their business. And that represents a huge portion of their net worth and a huge portion of what they should be thinking of as their investment portfolio. And that is much riskier than the rest. And so when people are thinking about exiting their business or transitioning away, the understanding of how that portfolio changes drives a lot of their understanding of what they need going forward and how to meet those financial needs going forward.
Yeah, let's talk a little bit more about financial needs and people really understanding in the years following your transition. What is your life going to look like, and what kind of income and financial needs are you going to have?
Right, and most people want their life not to change so much, right? They've had a life based on the business that they've been running and the income they've received that they've gotten used to. And if they haven't planned ahead to create that same income from different sources going forward, then they're in for a shock. And so when people think about the income expectation going forward, first there's a calculation of what you need from your income. what you need to live. And that's a function of thinking about what your expenses are today and what they'll be tomorrow and how they might change and what your aspirations are. And do you want to travel or do you just want to pay off your house? And what are the things that you want to do? But because they've been used to a very risky asset in that portfolio as a huge portion of that portfolio, their business, they're probably used to a return that's commensurate with that risk. And so higher risk equals more return, more income. And they've been taking that risk for a long time and they're used to that income. But moving forward, they may not own that asset anymore. They may be diversifying the liquidity they get from that asset into a portfolio that looks more like that first one we looked at. And that portfolio has a lot less risk in it and probably is going to produce less income. And because it's going to produce less income, they have to be planning ahead to make sure that the income it produces actually meets their need. And that kind of leads us into the next slide. That next slide is an analysis of what you have and what you need. And when you go through this decision-making process I just talked about of what is it that you're going to do and for how many years, right? Are you planning, are you 70 now and your life expectancy is 90, or are you 55 now and your life expectancy is 90? How long do you have to live off this money? And what is it that you want to achieve? And so when you go through that process and that exercise, it's important to understand what you have and what you'll need and how you'll fill that gap, or if you can fill that gap. Because if the value of your business isn't high enough, or your business isn't particularly attractive in the marketplace and you can't get the liquidity from it, then you may have to fill that gap another way. And so you can do that through ongoing proceeds, operate it longer, or through liquidity from a sale, proceeds from a sale. But that may not be what you think it's going to be. And so working through that early on, particularly with financial planners, financial advisors, is a hugely important step.
I think we're going to talk more about planning now, Bob, and you've mentioned before how important it is to start really early. Let's take a look at our next slide and go more into the planning part. Oh, actually, financial needs analysis. That's our next slide. Let's talk more about that quickly.
It all ties together. This is part of
Okay.
financial planning. So one of the key parts of financial planning is to understand what your needs are. And I've talked about this a little bit already, but if you want to maintain your current lifestyle and you're diversifying your portfolio into less risk, that means your portfolio's got to be larger. And so planning early, saving money to make sure that that portfolio is large enough to produce the income you need to maintain your lifestyle is hugely important. When people are looking at transition, unfortunately, they start thinking about it late. They start thinking about the planning aspects of it when they start thinking about exiting their business. And maybe they're not prepared. So if you're a small business owner, you may not have the same opportunities to exit your business that a large business has. You might not have a private equity group standing on the sideline ready to pay you $100 million. That's a whole different scenario than a small business owner who might have a business worth $5 million, but there might not be somebody out there ready to write them a check. They might have to sell that over time. They might have to sell that by taking some additional risk. And so understanding what your needs are and what your absolute minimum is incredibly important. And that leads you to how you'll meet those needs. And that's sort of the slides that we just looked at. How can you meet those needs? You can maybe get liquidity from your business, or you can operate your business, or you can get it by investing the proceeds from your business.
And Bob, you talk about the business and personal life cycle and how those kind of intersect. Tell us more about that.
And that's one of the things that when I talk to business owners, I regularly hear is I ask the question, what's your transition plan? What's your exit strategy? And invariably, 95% of the time I hear back, I'm going to sell my business in 5 years and retire. And the problem with that answer, there's two problems really. One is if you ask them the same question 4 years later, they give the same answer. I'm going to sell my business and retire in 5 years. And that's a rolling 5 years. The real problem with that is that they're expecting their personal life cycle to peak at the same time their business does, or them to be, put in a different way, them to be ready to retire at the time their business is worth the most money. That doesn't typically happen. And so if you're thinking about it from a purely economic perspective, what you would say is, I'm going to sell my business when it's worth the most money, and I'm going to retire when I'm ready to retire. But that's not very practical either, because maybe your business is worth the most money after you're ready to retire or way before. And so timing is important both from a valuation sense and a market sense, but also from a personal sense. And understanding how that timing could affect your exit and your retirement is one of the things that professionals can help you with. It's one of those things that if you don't think about it until the last minute, I'm going to retire in 5 years and sell my company, and you get to that fifth year and you happen to be in a recession and you can't sell your company for what you thought, that will change your entire financial future. And so understanding what you need, when you need it, and how you're going to get it is the most important part. And I say this over and over and over again on every slide. It's the most important part of transition planning. You can talk about what you're going to do, how you're going to do it, and that's great. You need to have that plan. But if that plan doesn't meet your financial needs, then it's not really worth very much, because at the end of the day, you don't have what you need to move forward.
So it would be really hard to get the timing just right if you didn't do the planning.
It's hard to get it if you do the planning. And if you don't do the planning, it's nearly impossible.
Okay. All right. So let's talk a little bit more about planning for transition. We have a slide up, and tell us more about that, Bob.
So the planning, the earlier you start, the better. And I'm starting with that last bullet point because that's maybe I buried the lead on this slide. That's probably the best thing to say is the earlier you start, the better, because there are lots of tools available as you're running your business to plan for retirement. There's all kinds of, we all know about a 401k plan or IRAs, but there's all kinds of tools that a business owner has at their fingertips if they're working with professionals that help them with that can help minimize the need for liquidity from the business at retirement. And so if you've done the planning and you've customized a plan for yourself, and you've done that in conjunction with people who know how to set up these plans, maybe it's a deferred compensation plan, maybe it's a 401k plan. There are all kinds of ways to do this. But if you've done this early and you're prepared yourself, then that statement, I'm going to sell my business in 5 years and retire, might actually be a true statement because you're prepared. You have what you need to retire, maybe without the liquidity from the company, or needing maybe not all of the value of the company to retire, or maybe you can live off some of the proceeds from an ongoing operation as you sell it slowly over time. Again, smaller businesses have a tougher time getting full liquidity, at least full liquidity up front. And part of that is because there just aren't as many buyers for it. And because they aren't worth as much money as larger businesses. Size matters when it comes to valuation. And so as you work through this as a business owner, the earlier you start, the better prepared you are, and the better you can control your timing.
All right. Well, that's good advice. We're going to go for some final thoughts from you, Bob, in a minute. But first, we have a few questions. First question here, and thanks to those of you who are typing in questions on LinkedIn for us. Question is, if I'm not ready to retire, is there a way to stay involved in my business?
There's all kinds of ways to stay involved in your business. And I assume that not ready to retire, but maybe want some liquidity. And so it depends on who your buyer is. Oftentimes, small business owners will sell to a management team, or they'll transfer to their children, or someone else they know, or a friendly competitor. Often when that happens, they're not getting full cash up front. And so maybe you could transfer some at a time, a little bit of your company at a time. Even if you sell it all at one time, often if it's to a management team in particular, they might want you to stay around for a while. It might not be just, I want to stay around. You might have to stay around because they'll need your expertise as the transition of the business operations take place. They might need your relationships to transfer with their customers. So frequently in a transfer of smaller businesses, the owner can stay involved for an extended period of time, or at least for a short period of time.
Okay. But it all gets back to doing that planning so that you have the options available when you're ready.
Exactly. You
Yeah.
want the flexibility to be able to stay or not stay.
Hmm. Okay, another question here. What happens if my business isn't worth enough to fill the financial gap?
Well, that's the question that everybody faces, and if that's the case, unfortunately, what you're likely going to have to do is change your lifestyle. I mean, there's not much you can do if the business doesn't have the value to provide the liquidity to produce the income you need to live at the level that you've been living. Then you need to change the level at which you're living, or hold on to the business and try to increase the value. Holding the business for longer means you take more risk for a longer time. But if you have a good cash flow stream from the business, it's never too late to start saving, to start planning. And so if you're getting that money today, you don't have to give it up immediately. You could stay, run the business for a little longer and save some more so that that gap starts to shrink. You might not be able to eliminate it, but the smaller you can make it, the less you have to adjust your lifestyle.
Yeah, there's another question about how can I prepare for life after my business? So that kind of goes hand in hand. Even if you're 10 years away from selling your business, from wanting to sell your business, you can still start planning now for what your life is going to look like or what you want it to look like after that.
Absolutely. And some of that is financial and some of it's not, right? Life after business, often when I talk to business owners, the thing that they're most worried about is what am I going to do tomorrow? It's not am I going to have enough money to survive? It's not am I going to be able to go on vacation? It's what am I going to do when I don't get to go into my office and see the people I've seen for the last 30 years who feel like family? And how am I going to take up my day? And how am I going to fill that emotional gap? And those are things that you should start thinking about early as well. Because if you have nothing to do the next day, then the next day is going to be miserable. And if you have
Mhm.
nothing to do the day after that, it just gets worse. So exiting your business isn't just, like I said, an economic exercise, it's an emotional exercise. And the more you prepare for that and the earlier you start preparing for it, the better you'll be.
Mhm. Okay, Bob, another question here. Any thoughts on employee buyouts? I know that's a big subject, but what are your initial thoughts about that?
So it depends on the kind of buyout. I think employee buyouts for a lot of people may be the only path for them to leave their business. They can be risky. You have to make sure that you've got employees who are capable of running the business, employees who want to run the business. But employees, keep in mind, they're almost never going to have the amount of money it takes to pay for the business upfront. So you're not going to get all cash. You might get some cash, right? You might be able to, they might be able to finance a piece of it. And there are programs that help employees buy businesses and help business transfers take place, particularly SBA programs for smaller businesses. But you're very likely going to have to hold a note for some portion. And that note is going to be a risky asset in your portfolio. You'll get paid on that note as long as the business operations support the payment. And so when you structure a transaction like that, it's not only important to think about what the value is, but what the cash flow of the business is, how much it can support, and to structure any note that you have in a way that provides some flexibility for both you and the business and provides protection for you as the seller. And so there are ways to structure those notes that if they miss payments, that you can go back in and take control, or you can maybe take the business back. I know most people don't want to do that, but you have to have some sort of protection built into it. It's a great way to exit for people who don't have other options, but it's a risky way to exit because the people who are buying your business are now running your business and you're out of it and you're dependent on the cash flows.
Hmm. Yeah, a lot to consider there. All right, we're going to pop that slide back up, the one that is showing your final thoughts. So give us kind of the summary of what we talked about. What are the takeaways you'd like to people to remember from this conversation?
Yeah, and I think if they don't have them yet, I've repeated them about 90 times now. You really have to understand your financial needs before you enter any sort of transition. If there's a gap that's left, you're going to be unhappy at some point. Understanding the implications of timing is incredibly important, and it's okay to delay and get less value if that's worth it to you on an emotional basis. But understanding the economic trade-off that you make for emotional decisions will help you sleep better at night after it's done. Exploring your options is important. You might have many options. There might be lots of different ways for you to transition, but there might be only one or two. Knowing what they are and how they operate differently economically and how they operate differently qualitatively will help, again, give you peace of mind at the end of the day that you've done the right thing. And finally, start early, because none of this can happen overnight, especially the financial planning aspects. The idea that if you start very soon and you are creating a process that mitigates your dependence on the business for your financial support at the end of the day, the better off you'll be.
All right, that makes a lot of sense. Well, thank you so much, Bob, and thanks to all of you who watched us here on LinkedIn Live and put your questions in. We really appreciate that, and we will see you again soon.
Thanks, Susan.
Thanks.